Angel investing, seed capital, venture capital, private placements. We hear many terms nowadays. What do they mean? At the very start, there is just the entrepreneur. He or she might start in the garage or basement. At this stage, the money invested is own money. This is an early stage, when an idea is just formative, experimental. Soon enough, some initial work is done, but more money is needed to prove that the concept works. At this stage, there are some people who arrive like angels, the angel investors, to provide the enterprise with the money it needs. Not every enterprise that an angel invests in succeeds. In fact, most fail. But a few do manage to prove the concept. Now comes the challenge of demonstrating that this business can attract customers, can generate revenues. To be able to open that channel to the customer, all sorts of things might be needed. Maybe commercial packaging, maybe retailing deals. So maybe more money is needed. But this is a less experimental stage. Money is available for the venture from venture capitalists. When products begin to sell commercially, there is a need to open outlets, increase the scale of the business, perhaps go national. Now the business is less uncertain than ever before. Private capital is available from investors who like proven enterprises. And then comes the moment when the business needs to go national or international. Not only do you need capital at a large scale, you also need to be visible to the world in many different ways. The public markets provide capital and many other benefits to the company. While these stages are presented here sequentially, there is an overlap between some of these phases. To understand how the angels, the VCs, and the private investors make money, let us look at how these stages occurred in the life of Google. It was August 1998 when Andy Bechtolstein gave $100,000 to two youngsters who felt that people needed a way to search for what they needed on the internet. An angel investor like Andy might give out this kind of money to over 100 people with ideas every year in the hope of backing something that will achieve its promise. That is a lot of money in all. But here is what happened next. With Andy's money, Larry Page and Sergey Brin built Search. A year later, the venture capital firm, Kleiner Perkins, invested $25 million for a 20% stake. This means that Google was already worth $125 million by this time. Just 5 years later, when the company went public in 2004 to raise $1.67 billion to fund growth, it was worth $23 billion. At the time of the IPO, it is estimated that Andy's stake was worth around $1.5 billion. Kleiner Perkins' stake was possibly worth $2.3 billion. If Andy had given $100,000 to 100 kids, he would have laid out $10 million as an angel investor. Assuming the remaining 99 investments failed, Andy still did fabulously well. His outlay of $10 million in angel investing in 1998 translates to around $24 billion in value in 2017-18. And that is the reward of angel investing and taking bets on ideas. Barely 20% of investments make it past the first two stages, and hardly 0.1% make it this big. But of course, he might not still be holding on to all of his Google shares. Investors keep selling shares for their own needs of cash, and that is one of the roles of the market, to provide an exit for early stage investors. Learn markets better with MarketTechPro.